In the alternate version of exercise 12-1, we're presented with a list of different transactions and events that happen during the year, and we're asked to indicate if they appear on our statement of cash flow, and if they do, whether or not they appear in operating, investing, or financing. If maybe perhaps they don't appear directly on our statement of cash flow, but in a separate schedule or in a note related to non-cash investing and financing activities. Or last and not least, maybe perhaps they don't appear on the statement of cash flow and don't even impact a note. So we're asked to indicate which column or columns it fits within with an X. An important point to indicate is that this particular company, when it's preparing the cash provided by operating activities, uses the indirect method. Keep in mind there's two alternatives. There's the direct and there's the indirect. They happen to use indirect, and that can be an important point to keep in mind as we're going through the transactions. So quick note, not going to go over full detail that's in the book, but operating activities are normal day-to-day stuff. So if we're looking at the cash impact, it might be collecting cash from our customers, paying taxes, paying wages and salaries to our employees. Those are things that we do on a day-to-day basis of operations, and so the cash impact of those would appear in operating activities. Investing, we're going to look at longer term assets. So this may perhaps be equipment, either the purchase or sale of that, maybe notes receivable, items like that. Your book talks about that there's some exceptions to some items of maybe some investments, maybe some short-term notes receivable, or some short-term investments that may still fit within this particular category. So make sure you thoroughly review your chapter on that. Financing tended to be longer term liabilities. Keep in mind, oftentimes we finance a company through one of two ways, either through debt or equity. The cash impact of financing activities typically includes either long-term liabilities like notes payable or bonds payable. Again, your chapter talks about some exceptions to that rule because we've always got to have some exceptions. And on the other hand, equity in general. So let's start to attack these one by one. Our first item is selling long-term investments for cash. So there is a cash impact, so we know it's got to fit somewhere within the first few columns. And this is a long-term asset. Long-term investments, keep in mind, it's not somebody investing in us. This is not common stock. This is maybe perhaps stock that we own in another company and we hold on to for a long-term basis until we made a sale here for cash. So that's going to fit within our investing category. The next item is receiving cash payments from customers. Definitely has a cash impact, first three columns. I mentioned earlier, operating activities is that normal day-to-day stuff, and getting cash payments from customers fits within normal day-to-day operations, so we'll check off operating activities. Our next item is paying cash dividends. So, not a normal day-to-day thing, is unrelated to investments. I mean, this isn't related to, equipment or machinery or an investment or stock we own in somebody else. This is related to stock owned in us, either common or preferred stock our shareholders own, and we've made a cash distribution in the form of a dividend to them. This is going to be considered, because that's related to equity, this is going to be considered a financing activity. In particular, it would be an outflow under financing activity. So we've got an additional item. We're going to pay cash interest on a note. Now, what's confusing about this is you look at paying cash dividends and you say, well, that was related to equity, they're common and preferred stock, and I made a distribution and I said financing activities. So a note, like a long-term note, would be financing, and so we're paying interest on it. It seems like it would fit within financing. But we in accounting want to make things confusing. This is actually going to fit within operating activities. It's considered more part of the normal day-to-day thing is paying interest expense related to a note. As we jump into the operating activities section, we'll give more explanation. We'll talk about that the typical items that fit within operating activities also affect net income. Keep in mind, interest expense is a deduction of net income, and so again, normal day-to-day costs. So that's why a cash interest on a note that we pay is going to fit within operating activities. The next item is we're going to receive cash from the sale of land at a loss. So in this particular instance, they're receiving cash from selling a long-term asset, which is land. So you might think, well, that makes sense. That's an investment somewhat similar to A, where we sell a long-term investment for cash. But we have another important point. They're selling it at a loss, and that's a very important point. What that means is they received less cash than what was on their books, so they had a loss. This does first fit within investing, but also as you delve more into our operating activities section, when we use the indirect method, you'll see that we end up having to make an adjustment to go from accrual-based net income to cash basis of cash flow from operations for any non-cash expenses or revenues, and loss happens to be one of those items. So we'll actually make an adjustment to operating activities to back out that loss from a net income and help get it to its cash basis. Our next item is issuing common stock for a building. This item is going to not have any cash impact. It's going to fit within non-cash investing and financing activities. Keep in mind that part of it is financing related. We're issuing common stock. If we did it for cash, it would fit within financing. The other part is that we're acquiring a building. They're exchanging our own common stock in exchange for a long-term asset, a building. So the other part is investing, and if we had paid cash for the building, it would fit within investing, but no cash is actually transpiring. And you may initially think, well, don't report it on the statement of cash flow at all. But when we have significant investing and financing activities like this, even though they don't impact cash right away, we want to make sure we include this either in a separate schedule of non-cash investing and financing activities or in the notes to the financial statements, because all told is eventually this may perhaps impact cash. And ultimately, when we have significant acquisitions like this, we just want to make sure that we alert our investors and creditors. Our last item is going to be paying cash for wages and salaries. One would hope that this is a normal day-to-day thing, so this is going to fit within operating activities.